East Coast time. Um, VMware team, thank you very much for attending. It is Wednesday, May 10th for 4 p.m. East Coast time. Today, we have Gary Pinkerton from Paradigm Life joining us, along with special guest Aaron Chapman. Today's topic is going to be infinite banking. So just to make sure everyone knows, housekeeping, please everyone stay on mute. Ask many questions on chat. We should have time at the end. We have a full hour. We want to be done by 5 o'clock East Coast time. Gary will provide contact information at the end. If not, I will go ahead and do so after the call. And just remember, all this is educational purposes only. So on that note, Gary, floor is yours.
Awesome. Well, I deeply appreciate connecting with everyone. And I guess we got Aaron Chapman in there to make sure that I tell the story correctly.
Well,
stay
you
on
do
path.
stuff on the fly.
So listen, just as a quick background about me, and is it appropriate to share screen, or is it best just to kind of talk through things, Kish? Does it matter?
Share screen, share anything and everything you want.
All right, brother. I appreciate that. So just a quick background about me and where I came from. I'm 54, I grew up in Southern Illinois. This is all relevant, I promise you, with respect to where I invest, how I invest, and some lessons that I've learned over my lifetime. So you ought to be seeing here in the near future a thing that says, who am I? And so as I mentioned, late 70s, early 80s, grew up in an environment of really, really high inflation. It rhymes with what we see today, stagflation, where people's their wages are going up much slower than the expenses and the costs are going up. House prices are skyrocketing and they're priced out for everybody to buy homes. And interest rates on mortgages are just going up and up and up. And so Reagan comes in and he gives Paul Volcker, Fed chair, permission to fix inflation. I'm not sure we have the fortitude to do that today, but I truly hope we don't ever get to the rates that they had to go to make this stop. And it was, in the end, it was 21% interest rates in early 1984. And that evaporated any equity we had in our farm, because you had variable interest rate loans from the local banks on our farm. For some reason, it was just the new thing that the banks were trying, and the farmers were kind of the victims, and it wiped a lot of us out. Certainly did us. We were living on this, a trailer on my uncle's land, had really no assets. And I was out personally as a teenager running businesses, trying to make ends meet for the family. The reason I tell this story is because it is so similar to today. And it drives me at my core to why I buy single family homes, 1 to 4 families. And I get long-term fixed rate financing on them from one of the best dudes on the planet at doing that, but at many other things too. And so I met Aaron Chapman when I was trying to get as many rental properties as I could in my own name and my wife's name, and protect my family from round 2 of losing everything due to inflation. So there's a little bit that happened in between those two. So around the time that I was leaving high school, I'd gotten things kind of stabilized. My father's health was kind of stable, and he was able to maintain some stuff while I was gone. And my parents said, hey, go off and make something of yourself for a couple of years. You'll probably have to come back and take over. So I tried, and I got accepted to the Naval Academy, which it had 2 really important things going for it. It was as far as I could possibly get in mainland US from Illinois, which I really wanted to do at that time because that place was just desolate. And the second thing was they offered a safe, secure job. Oh, there was 3, and it was free, which was exactly the price that I could afford. And so I went, and I was a fish out of water, completely outclassed. And I got an opportunity, though, after a tremendous amount of hard work for 4 years, to interview for the Navy nuclear submarine program. And I got it, and I got in, and I did 4 years there after getting a graduate program for nuclear engineering masters, and commanded the USS TUCSON, pictured here. Had an opportunity to work on the chairman of the Joint Chiefs Staff. I taught ethics at the Naval Academy again. So I had a wonderful, wonderful career. But there was a weird and very impactful thing that happened to me again. So this is like the second huge thing in my life that has driven my recommendations on investments for everybody. And that is 2009 to 11 is when I had command of this submarine in Hawaii. And I was out in the Pacific Ocean paying no attention to anything on headlines or finances or whatever. And here I am in 2011, giving up the submarine to the next guy so he could get ready for his deployment. And I started looking at my personal finances and realized I had lost half of my family's wealth in the Great Recession of 2009 to 11. And that beat me up to my core because I was not going to let my kids live in the poverty kind of childhood embarrassing situation that I grew up in. Come hell or high water, I wasn't going to let that happen. And I felt like I'd let the family down. And so I wanted to change things. And so I didn't understand, first of all, why it had even happened to me. And all of my money was in the market. Some professional was handling it. And so I threw myself at learning how is wealth grown successfully and how is it held on to for generations? And, what techniques did they use? And it taught me a lot of things about, the big stealers of wealth, like future family members that don't understand how to grow wealth. And Aaron has taught me actually quite a bit about that and how to deal with our children and how to teach and train younger generations. But the big one is taxes. And so how do I prevent from taxes taken? But inflation and taxes go hand in hand on stealing wealth from hardworking Americans who are trying to make something for their families. And so I've dedicated my life to helping teach people and put in place tools on how to prevent that from happening. And so is Aaron Chapman. So we're pretty good standing side by side here on your picture because we work hand in hand with the same goal of helping people turn their lives around. So I learned about a lot of things. So some of it was, where to put money, where not to put money. And I learned about some other things, tools I'd never heard of before, but in fact had been around for 300 or 400 years when I learned about them. And one of those is this infinite banking thing. And I had no idea what it was or why anybody would put money in life insurance. Like, how could you store money in life insurance to begin with? I think it was, I probably knew that there was whole life insurance and term insurance, but that's about all I knew. Yet, as I read more and more and more about the Rockefellers, our Carnegies, many other families, I realized that the old school way, when banks were not very dependable, and I guess that's happening again now too, right? But back when bank runs were common in the 1800s and 1900s, people didn't store their family's wealth in banks. They would put it in life insurance policies. And then when it was time to plant crops or buy some land, they would cash in their life insurance policy. Eventually, it got to where you could actually borrow against your life insurance policy. And so today, those wealthy families that learned this generations ago still do the same thing. We all think everybody puts their money in banks and just stores it there. But the people that I don't actually rub shoulders with or didn't, for many years, most of my life, I didn't know that they treat banks differently than I do. And so for them, banks are just a tool. They are a transition tool of where you can get money and move it from one place to another. It's not where they store wealth. They store wealth in directly owned real estate, directly owned businesses, and in life insurance policies because they are safe and within their own control. And so I learned about this, and then I met this guy, Patrick Donahoe, who is a dear friend, a mentor, and a guy who he taught me everything I know about life insurance and a lot that I know about growing wealth, permanent wealth for families. And this was in 2011. I was getting ready to buy my first rental property. And at the time, I couldn't actually articulate, like I've done for you, why I was buying real estate. I just knew that I was repelled from the stock market and I was called to put my money into real estate. And so I studied, right? And he started talking to me about this concept that he calls hierarchy of wealth. And it's really adapted from Maslow's hierarchy of needs. And the entire purpose of this thing is to get across a lesson that we have learned time and time again after tens of thousands of hours with thousands of clients and prospective clients over the years. I had heard for years, and you've probably heard that there's a relationship between risk and return. Every time I went to see a new advisor, he would say, well, how risk tolerant are you? Because if you're risk tolerant, if you're open to risk, you should have good returns, high risk, high return. That just didn't play out for me in 2009 to 11. High risk also meant high return that was negative, high losses. So what Patrick said is, no, you know what I've learned after all of these hours and all these years is that if you have a lot of control over your money, then your risk is low, and vice versa. If you have, imagine a roulette wheel at the casino, and you take all your family's wealth and you put it in a couple of chips, and you put those chips on the table and you pick a number and they spin the wheel. You have no control, no insight into what's about to happen, and therefore you're at ultimate risk. The opposite side of that, you take all the money and you store it in a safe in your house with good guns sitting around, and you know how to use them, right? Like that's pretty doggone safe. And so everything else is in a spectrum between those two. And Patrick puts that in his book, Heads I Win, Tails You Lose. It's a fabulous book. I've learned a ton. It makes you question the really kind of typical advice that you've heard since you were a kid. I will make it available to anybody who wants it. But in case I'm going to forget later, I'll just say it now. And it's, I think, on my slide later anyway. But you can just email me at Gary@GaryPinkerton.com. Try to make that pretty simple. Gary@GaryPinkerton.com. And you can put in your information there, and my team will send you a copy, ebook and an audio copy of this. In chapter 7, though, he talks about this hierarchy of wealth. There's a lot of other great conversation in there about retirement accounts and things like that. To simplify things, I've nicknamed these sections something that I think is pretty easy to understand. The top 3 levels are investments. The bottom one is savings. The reason, let me back up just a step. The reason Maslow uses this in his hierarchy of needs is because he's getting across, a point that these Egyptian pyramids are an example of a man-made structure that has lasted for thousands of years. And it's only done so, though, because, it's a good shape, a good stable shape, right? But the real reason is because the Egyptians spent hundreds of years taking the time to build these things out without skipping any bricks. They didn't skip any steps along the way. And so Maslow was saying, hey, listen, if you don't understand basic needs and you haven't solved the basic needs of food, shelter, and clothing, you will never care about community involvement and all the other steps on the way up to self-actualization at the top of this thing. So it's not our goal to teach you, certainly not our goal to teach you about emotional intelligence and emotional success. We're talking only about your money and what we have learned about the relationship between control of your money and how much risk you're taking on. And so specifically, who has your money? What are they doing with it? When are they going to give it back? And is it going to bring any little friends back with it? Are you going to get a return of your capital, and do you get a return on your capital? And it all comes down to how much control you have, right? And so in the investing world, again, which is the top 3, you have direct investing, indirect investing, and speculative investing. Direct investing is simply investing in ourselves. By far the one that you can count on the most. I hope all of you agree with me on that. Businesses, which are an outgrowth of your ideas and your involvement, and then directly owned assets. And so this answers the question of, why does everybody say I should do 1 to 4 families? Why is it that when I meet people who have, had generations of wealth, they always seem to have some real estate, right? Well, the reason is because you're in direct control of it. And no one's going to steal it from you, and no one's going to, do stupid stuff with it, because it's you and you have outlook of it, right? And you have control over it. And there's an indirect world up here. Indirect world is a little bit less control. Instead of you riding the horse to victory, you have a new jockey that you put on there to ride the horse to victory. And he may pick a different horse and he may steal your money, right? So like that stuff can happen. And that's why you start at the direct control level and maybe never go above it. There are a lot of people, I can name quite a few you've heard of, Elon Musk, Bill Gates, a lot of other people, they never left this level. They've bet on themselves 100% and never left it, right? So you don't have to go above it. Some people want to, some people wish they hadn't when they did, but you're stepping up from there. And I hope that makes sense. And then the speculative level, well, I'm picking on the markets a little bit here, not because of the markets, but because most of the people I know deal with the stock market the way I did. I point and clicked at best to pick something myself and then forgot about it. Normally, though, my money automatically went from my paycheck to a 401k or an IRA or to my brokerage account, and some other dude who got the memo today from the boss on what he should invest in just goes and invests my money, right? So like there are so many people between you and your money and what it's doing that the likelihood that it gets lost and you never see it again is really pretty high. So, I teach people all the time, and my role as a wealth strategist is to work one-on-one with people for the rest of our time together, whether that's, 5 years, hopefully it's 50 years. And it is about laying the bricks in here, assessing periodically, where are we and where does the next brick need to be put, right? For success, for long-term generational success. But underneath all of this, is my actual licensed day job, my like the first element of things. And that's to help you put in place tier one. And tier one is not an investment, it's savings. My definition for investment: send my money off to do my bidding, understanding I may lose it completely, but with the intention and the goal of doing enough due diligence and doing it with the right people that I get the money back, right? So put it at risk of losing it to make it grow faster. But savings is different. Savings, to be, on this foundational tier one layer, has to be safe, liquid, and guaranteed to be there anytime I need it, period. So if it can be lost, it can't be a savings account, right? So I have people who say, oh, well, that money's in my safe stocks. That's not possible, right? I lent it to my friend to hold on to for safety. Like, that's not possible either. I know you like your friend, but it's just not possible if it's not safe, liquid, and guaranteed. And there's a few things that meet that criteria. Savings accounts, hopefully, a CDs, a safe deposit box, safe in your house is a really good idea. And then whole life insurance for the entire history of America, whole life insurance from companies like Penn Mutual, Mass Mutual, it has been their job, and they've had a zero default record of saving, collecting, protecting, and growing your money and giving you access to it when you want it. And so this asset is, it's about, it's an emergency fund, right? It's a better place to store your family's emergency money. And it's also a place where I store reserves for all of my properties. Sue and I have bought probably 30 over these years from Aaron, and we have, about 18 doors right now. And it's kind of a sweet spot for us right now. But it's reserves for those properties, and it is reserves for, my businesses that I'm growing. And so, it's kind of those two. And then everything else is opportunity money. So this is what we love to talk about, right? This part of it. And that's awesome. I do too. And so the opportunity money part means store my capital here, access it, have it do the bidding for me in this next real estate property, and get cash flow from the property, use that to replenish. And that allows me to build an even bigger foundation, which allows me to grow this thing. And so it's this process of just cycling through and continuing. Again, you never have to leave that row. I have a dear friend that lives near me here in Florida. He's been investing in rental properties, single family homes locally for 50 some years. And he's a multi-millionaire living a tremendously gratifying life. So, Kish, I don't know, should I give me a thumbs up or down? Like, should I keep going, or are we on a good path here?
I see a question that
Yeah.
showed up. Someone asked, Aaron asked,
There we go.
different Aaron, what's an example of an indirect investment?
Indirect investment. That's great. Yeah. So let's go back to these pictures up here, right? So an indirect investment is a syndication, is how we normally hear it thought of today. And so that is, you hand your money off to somebody who's running a fund, or they're raising money for a specific apartment building or self-storage facility or mobile home park, oil and gas kind of thing. And so it is you handing your money to somebody else to shepherd for you, and they're making the decisions. You're not making the decisions anymore. So you can go kick the tires, you can check out the facility, you can see if they're working there or not, or if they're being kind to the tenants of the apartment building. But in the end, you can't say, listen, I'm the owner here. You're in a more passive role, right? So it's a step more to more passivity, which means that you're giving up control, bottom line. But it can work successfully. It works for a lot of people, but you can also lose pretty big in that world. And then there's, speculation, which is like, I don't know where my money went. Fidelity's doing something with it, hopefully that helps.
You got to get that balance though between active and passive.
What's that again about active and passive?
Yeah, so you said with syndications, it's less active because you have no control.
Yeah.
But it's also more passive. So with busy people like at VMware,
Yeah.
That might be more, lucrative because it's less activity. But you're right; they have to kick the tires. They have to do their due diligence. They have to make sure it's just an investment.
The point. Yeah, exactly. That's a great point. Is it's not that that it's not possible to be successful up there with less control. You just have to put some other kind of protection in place. You have to have a really, really good relationship with the individual, and you need to know them to the core. It's also helpful if you know how they react in good times and bad times, not just good times. And know how hard are they going to fight for you and your money and your family's well-being. That's a great point. Yep. It's a more advanced way of operating, I would say. All great points. So, so as I mentioned, though, my day job is in this, helping you put in place the foundation underneath it, and then help you over time work towards a strategy that is personalized and helps you get to that next level. So a part of that, again, is saving on taxes, and that is a graduate program in an understanding and being able to teach that to clients. I mean, that it gets really complex very quickly. And again, it's different for most clients. Everybody has a different situation. And so as much as people would love to, sorry, I didn't mean to get rid of that. As much as people would love to make that boilerplate where everybody does the same thing, it is far, far from that. Okay, so a couple other quick things. You will hear some people give advice like, pay off everything, don't have any debt. I'm not that guy. I think that is very basic level thinking. One person who does tremendous things for people who are addicted to debt, they have a spending problem, is a guy named Dave Ramsey. Many of you probably heard of him. He has done some tremendous, wonderful things for people who can't handle debt. It's a weapon that they should not have in their hands. And so they get eaten alive by consumer debt that spirals out of control into bankruptcy, right? And for those people, the advice is really good advice. Go and start doing everything with cash, right? And so, save money up, cut up your credit cards, save up money, spend the money, and then save again before you spend again, right? Stay above water up here. And that's great advice, again, for people who can't handle. I'm going to make the assumption that not too many people on this webinar are in that situation. Yet most people go through life not realizing that there's a graduate course, right? So Dave Ramsey's point is that debt is a very powerful instrument, and it can eat you alive if it's working against you. But if you get it working for you, it's also powerful, right? And so the graduate course is prudently use debt, use leverage in your favor, not against you, to grow wealth and accelerate those timelines, right? And so when I use Aaron's team to borrow to put a very small amount as a down payment in a property, let's say it's a $200,000 property, I put 20% down or 40,000, right? I've borrowed 160. So I'm controlling a $200,000 asset with $40,000, right? That's incredible leverage. And so as the tenant pays off my mortgage, I wake up one day and the house is paid off. And as the $200,000 asset goes up at what do you want to say inflation is today? Let's call it 10%, right? So if that house is going up at 10% a year, $20,000, and I have a $40,000 investment, that's 50%, right? So using leverage appropriately and at a level that you can handle it is one of those things that gets you not only protecting your family from inflation, but growing wealthy with speed. And so that's why I push people to have directly owned real estate that they have prudent 30-year fixed leverage on. I actually buy real estate for the benefit, the ability to get the 30-year fixed loan. That's the whole reason that I buy it, because I want to be able to, instead of having $200,000 to buy $200,000 worth of gold, that's a good start, but I can buy $1 million worth of real estate and not only just protect my family, but allow myself to grow wealth, because I'm sitting on the same side of the table as the Federal Reserve, not the other side of the table like I was a kid and became bankrupt as a result. So using debt to your advantage to promote what you're trying to do can be tremendously beneficial if you know how to do it and you do it correctly, prudently. And so the same thing with a 30-year fixed mortgage, you can do it with a down payment, right? So the way that I purchase real estate is I'm borrowing I'm borrowing from the bank for everything but the down payment, and then I borrow against the property or policy to fund the down payment, right? So I have two loans going on, really essentially nothing out of my own pocket, and then I pay those back with cash flow from the asset, while the asset goes up in value because of inflation, and my equity grows because the tenant's paying the mortgage down. And then there's tax benefits, right? And so that's just a quick summary of why real estate's fundamental and why leveraging real estate with prudent debt makes a much bigger difference. Any more questions come up there as I'm kind of shifting here?
Just to clarify, so if you have a property that you want to purchase, like a rental, you say you get one loan from the bank, like a normal bank, And then the down payment, you just pull from your cash value as a policy loan.
That's correct. Yep.
And then you have two loans, like you were saying, and then as soon as you start getting cash flow, which one do you pay off first? Do you pay off the cash value first, or do you pay off the loan, or how?
Well,
how does
I
that
make sure
happen?
that I make sure that I'm consistently paying the the conventional loan or the other guy's money. And then when cash flow is available, I pay off the down payment loan. So the down payment loan is what's called an unstructured loan. The insurance company, I'm trying to find here real quick an example of a picture of that. But what's important is that to understand that the loan against the policy is an unstructured loan, meaning that there's no required repayment structure on it. And the reason is because they're not, the insurance company is not using the property as collateral. So when I get this down payment loan, right? I'm sorry, when I get the 30-year fixed mortgage from Aaron's team, then that's 80% of it, and they're using the property as collateral. And so my primary payment goes back this way, right? That's the fundamental initial way of doing it. But instead of sticking my own money in the property as a down payment and locking it up in something that's going to earn me 0% as a down payment, instead of doing that, I put my money here. And with my money sitting in this account, I go to the insurance company, borrow their money, and have them put their money in. And then when I have net cash flow, it goes back this way. But I don't have to make that payment because it's an unstructured loan. Why is it unstructured? And what unstructured means is there's no qualification requirement for it. There's no structured repayment. They don't care what I'm using the money for or when I pay it back, because they are using this as collateral, not the house. So instead of putting my own money in, I have my money set up here. I borrow against it and put the insurance company's money in and then pay them back when I can do so. Does that clarification work?
For me, it's good.
Okay. And the other thing I want to make clear, you will hear people say you borrow out your own money. And you pay yourself back the interest. Neither one of those are actually, they're not technically correct. They're close enough, I guess, but sometimes it leads to confusion. So when you borrow, you're borrowing the insurance company's money and yours sits up here as collateral. It never came out, which is why they continue to pay you the 4 to 5% return, because you didn't take it out, right? And then when you pay the interest back, it's going back to the insurance company. So yes, it does pool together with all of the money that they made in the economy by lending it out to real estate developers and business owners. And so they pool all this money together, and then that goes to us as policyholders. So in a roundabout way, it comes back. But I think it's important to realize that you're not borrowing out your own money like you take out money from a 401k. Because when you take the money out of a 401k in a loan, it's not working in there anymore. It's not growing. Or when you take it out of your checking account, it's not there anymore, right? So it's not growing. But the money in the policy is there continuing. It's just simply collateral. And so we borrow and repay. Okay.
Thank you. There's two more questions about, well, I guess it's a combination. One person asked about hard money loans.
Go ahead on hard money. Yeah, can you use it to do for hard money loans? Absolutely. Yeah. You can use it to start a vegetable garden. You can use it to take your family on vacation. You can use loans to put your kids through college. Some ways in which it's really, really valuable is hard money lending, right? Like that example, because most of the time people are lending, they have a pile of money that they need to get ready to lend out to the next bar or the next turnkey provider or whatever who's doing the rehabs, right? And he's like, oh, sorry, I'm a little behind. I don't need the money yet. So it sits in your checking account, right? And it comes back and the next deal's not ready yet. And so there's these periods of time where it's sitting in your checking account earning nothing. And obviously when it's in the deal, it's earning nothing. So this is a place where you can store it and it's going to grow at 4 to 5%, no taxes on the growth. And it's at the ready to be able to go into that hard money loan. And then when you do make the loan, it's still growing in the background, right? Your money didn't go. Your money is sitting there. You borrowed money from the insurance company and you're paying it back to them. Your money sits there and continues to compound without interruption.
One quick point to make there with respect to the unstructured piece. So to kind of help make sense of it, the reason it's unstructured, they already have the liquid there.
Yeah.
It already exists. They already have it backing it up. The liquid sitting there that you put in that's actually growing because they're using it. So they already have the capital. That's why they're not structuring some way of you paying it back. Anything else that you're paying back is because you took something that doesn't that there's nothing left in an account of sorts for them to replenish for themselves. That's why they have a repayment schedule on anything else. So that hopefully helps
Right.
why it's unstructured.
Yep. Yeah. I thought I would run through a quick scenario, but I'm happy to answer. I see a couple more questions there. I can actually, I guess I have the ability to open this up and look at it myself.
Absolutely.
All right. So hard money loans. And then the next one is, what if you don't have an insurance policy? In that case, do you recommend to go with hard money lenders for down payments on loans? Yeah, I mean, listen, if you don't have the insurance policy and you don't have the money sitting in a checking account, yeah, you're going to have to get it somewhere, right? Like, I have not done a lot of flipping. I've definitely not borrowed hard money to purchase properties. I think in this environment, I'd be careful about doing that. If you don't have an insurance policy and you don't have money in savings and checking, my recommendation to you as a wealth strategist is to pause, build money up in an emergency savings, like build tier one of that hierarchy of wealth, then think about that, going and getting that first investment, however it is. But if you have people making recommendations to you to borrow money on your credit cards because you don't have anything in savings, that's not me. I don't think that's a safe, intelligent move. You need to first build the foundational savings and protection layer for you and your family. I don't know if I got that question, if I understood the content there or the intent. And then are there catch-up options for whole life insurance policies? Yeah, so I think what that might mean is there is a catch-up feature, which means that you have an ability to make contributions to the policy. So I didn't really get into that, but here's a picture of it. So an ordinary whole life insurance policy is the exact same contribution every year. That is not the kind of policy we're talking about here. We're talking about the picture on the right-hand side, where I make that ordinary whole life a very small portion of it. And that money is growing as cash value. It's just slow to do it. It takes a couple of years. And so we don't want to emphasize that. We want to get more flexibility and make the money liquid on day one. And so the green stuff in this picture, the paid up additions, is where we send a majority of the capital on the top right of this picture. And that stuff's liquid and flexible, making contributions. And, let's say a policy has $20,000 a year maximum and would have like $5,000 a year as a minimum, or you could do $100,000 a year max and maybe $20,000 a year minimum. So it's a very scalable kind of product. And so let's go with the 20,000 a year max version. So 5 minimum, 20 max. So for several years, let's say the first 5 to 7 years, there's a commitment to contribute at least the minimum, right? And if you didn't do between the min and the max, like you left this stuff not contributed, which is allowed, the next year in most of the companies, each company is a little different, but in most cases, you can go back and you can catch up what you didn't put in that year. So you could put in the 20 for year 3 in this example, and you could catch up the 15 you didn't do in year 2. So I think that's what he was asking about for the catch up. If not, Israel, just reach back out with a clarification. And so one of the questions from Ray is, how do you get the insurance policy? So, it's a normal life insurance policy with a normal kind of, when you go out to get life insurance, you are, I think it's in this thing here that says, what's the catch, right? So the catch is that it is life insurance. And so you have to qualify medically. And if you can't qualify medically, then, that's surprising actually, because it's not that hard to qualify medically. But, let's say you had cancer last year, then, your spouse, family member, child, parent, I've only had one time in the history of my 10 years of doing this where I have not been able to find anybody in a family to insure. And it was a really, really devastating story. So I am confident that if you are interested and this resonates with you, I can help you make this happen. But basically you fill out an application, a health focused application, and they also look at financials to make sure this is an appropriate size that I'm asking for. Then once we get approval, then the ball's kind of back in your court to decide, yeah, I like the size. Yes, I like their offer they gave me. And you can decide that you do or don't want to move forward with it. So great question there. Yeah, and I think Ray was Kish was just replying to Ray. And then Rio says, which one is better, Penn Mutual or Mass Mutual? You know what, Rio? It depends. Sorry, but I represent both. I'm an owner of both. Aaron Chapman's an owner of both. And I think we're having a conversation here about whether Infiniti or Lexus are better, or Ferrari or Lamborghini when it's on a racetrack, right? There are no losers in this one. Mass Mutual's bigger, Penn Mutual's older. They have identical track records. They're both fairly easy to use for online access. They have slight differences on how much you can optimize the cash. It really comes down to the only way I can answer that question is in certain situations, Penn's better, Mass is better than others. What really matters is which one's best to you. And that requires an analysis of your specific financial situation. But that's a great question. The good news, Rio, is that you are looking at the best two out there. You're in the right neighborhood. Let's say it that way. Looks like I exhausted the questions for the moment. So I'll just go back and give a quick little example. Looks like we have time to do this. Let me just make sure. I think we're good still, right? We got another 20 minutes or so?
We do. Absolutely.
All right. So, okay. So what I wanted to do was, let me back up. So when you get one of these things started, in the first month, you can borrow around 80% of the value of the policy, right? Maybe it's a little higher if I use one company versus another based on your age and situation. And so we can optimize that as we're talking about it. But I represent 10 insurance companies. I promise you that we can find the best fit for you. You're not gonna have to shop around like you're, looking for used cars. And so I will teach you to whatever level of detail you're interested in on why one company versus another. And I'm happy to use whichever one comes out on top. So, but anyway, you're going to end up with like access to maybe 80% of that capital on day one. So there are people with a very kind of short-sighted approach that would say, in the next year or two, I can't imagine why I wouldn't make more money just using cash because I can use all 100% of what I have available for a down payment now. And that's true. If life is going to end here 2 years from now, or our investing career is going to end 2 or 3 years from now, you're probably ahead just using cash for the down payment, that is. Okay. But I don't think most people's investing horizon is like 3 years and that's it. Meaning like you're not going to invest for 3 more years, sell everything, buy a sailboat and be done with money. Right. So I think you're going to continue investing beyond that. So I'm going to do a little single family purchase example here, right? This is the good old days of a few years ago where you could buy a good rental house for $100,000. And we're going to get a loan from Aaron Chapman for $80,000. And look at that great rate. Man, I really need to update this. I also had some expensive, vacancy and insurance and taxes and that kind of stuff. And this thing was cash flowing pretty poorly. But this is a typical like 2020 kind of scenario here, maybe 21. All right. Okay. So need a $20,000 down payment. And the question is, are you going to use your cash out of your checking account for the down payment? Or are you going to borrow against your life insurance policy? I made the assumption that your policy is in place already, right? So you have a policy, you have 20,000 here and you have 20,000 over here. And what I wanted to do was show dollar for dollar, same dollars on both sides of the equation and play this out over a couple of years or over 30 years to see what happens. All right. So the cash buyer has his money in a checking account, and to purchase the property, he's going to empty his checking account. He's going to take his money from a place where I gave him credit for earning 1%. In 2020, that checking account didn't exist, but I gave credit for it. And after taxes, he was going to earn like 0.75% per year after paying the tax on it. But then when he takes it from that environment, he puts it in a house, it's not earning anything. Like the house is doing its thing, but the down payment isn't making any money because it's sitting there, right? And if you would like to kind of talk through that, I'm happy to do that as we go along here. So, okay. So if you understand the scenario here, he took 20,000 after getting the Fannie Mae mortgage, and he puts 20,000 in as a down payment. Okay. The other option is that you took the time to set up an infinite banking policy or a life insurance policy, and you have cash value in here, and you're going to, and it's earning 4.5% without taxes, still a pretty appropriate number for today. Maybe it's closer to 5 now. And you want to use the insurance company's money, not pay the opportunity cost of your money getting stuck in this house down here. So you go to the insurance company and you ask them to borrow, and for 5% rate, they put the money into the house. Now, it's not always like this. It's not always in a situation where you're paying at a higher rate than you're earning. I would say most of the time it's like this, where borrowing at a little bit higher rate. But I wanted to show it this way because I don't want to like give you some rose-colored glasses kind of thing where, like 2 years ago, for example, or last year even, I was borrowing at 3% and earning almost 5%, right? But that doesn't happen very often. So in this scenario, I wanted to make it the other way around. I wanted to be conservative and say I'm borrowing at a higher rate than I'm earning. Because if you can get your mind around the fact that that's not that important and see the numbers long term, then you won't get hung up on this. But many people get hung up on this right here. Right? There's just no way. Somehow he's cooking the books. I don't know what he's doing. It's a sleight of hand, but somehow he's tricking us, right? Because I know you can't borrow at 5, earn 4.5 on that and make out. And I agree. Based on that alone, you wouldn't be making out. All right. But the big picture is that over here, at best, you're making 0.75. And, for 30 years, you're going to be earning 0 on that down payment. And that's a huge difference to the 5% environment on the right-hand side. And you'll see over time, it makes a big, big difference. So after the first month, they make $107.36 after paying all their expenses. And that gets this guy over here repays his checking account. That seems like a weird word. Like, why did I say repay? Well, I say repay because one of the arguments or the criticisms about this approach is that, well, if I do that approach, there's a loan that I have to repay. But actually, 2 points. You don't have to repay the loan. Like, you can not pay it if you need to, right? Or want to. Many people do that. I don't think it's a great idea. I think you should repay, but you don't have to. No one's coming after you, right? And then the other thing is that if you ever want to do one of these deals again or do anything else with your checking account, you're going to have to repay this thing too, right? So in both cases, they both started with 20,000, and the guy on the left-hand side, he emptied his checking account and now he's making payments to fill it back up, right? The person on the right-hand side didn't take anything out of here. Instead, they borrowed from an insurance company and they're making payments to pay that one off. So however you want to do it, they're making the same payments with the same amount of money. All right. So both of them are paying the same thing. By the way, this unique cash flow that we had here, you're probably wondering, why did I choose exactly that cash flow in this scenario? It's because a $20,000 loan for 30 years at 5% happens to be this amount. So it's just really convenient for me. Right. But it's a decent, it's a normal ballpark kind of cash flow that we saw a couple of years ago. All right. So 30-year primary mortgage, I'm looking at over 30 years of them getting at rates, right? So again, a disclaimer here, I'm only looking at a very simple scenario. I didn't take any tax deductions. I didn't raise rents every year, right? I didn't have any, charges for laundry and carports. And I didn't do any of that stuff. I simply looked at a very, very simple situation, all right, to keep the math conceptual for us. Okay, but all of those other scenarios would be true on both sides of this picture, right? So if I could raise rents, they would both be raising rents. All right, so let's step out 30 years now, 360 payments later. What has happened on the left-hand side is that he paid off his mortgage and he made these $107 payments back to the checking account where it grew at this blistering 0.75% after taxes, right? So it earned nothing down here. And when it got put back up here, it earned 0.75, all right? And so 107, 360 payments of $107 growing in this environment turns into $43,000 if you use just a normal compound calculator. Paid off house, $43,000 in their checking account, right? It's not a great return because it's not a great scenario, right? Like we would raise rents for goodness sakes. Okay, so let's look at the one on the other side. You didn't put a penny in this account, this policy, during that whole time. What you did was you borrowed money from the bank and then the insurance company, and you paid them back the whole time. So what actually happened, and it got paid off, right? So same as the other side, the primary mortgage paid off and the down payment loan is now paid off. So what happened over here, though, is that the 20,000 grew a little bit the first year, and that part grew also called compounding, right? The growth also gets growth on it. And so $20,000 growing at 4.5% for 30 years is $77,000. And so this person has a couple $1 million of life insurance death benefit protecting their family. Their money is stored at a private, kind of off the grid facility that's not subjected to bank failure. It's got the death benefit, and it's grown at a higher rate without taxes. So hopefully that was a very simple side-by-side to the penny comparison between two different ways to fund the down payment on a rental property. And it works for funding a syndication. It works for starting your own business. It works for sending your kid to college. A couple questions in here, but open for Kish, any feedback on your side?
Looking at the questions right now, there is one question there by
Yeah.
Elisa.
Yeah, from Elisa. So is there a rate you get from the policy, or is the rate you get from the policy usually lower than the one you get from a bank for a mortgage, or the same? It's been kind of up and down. I would say that generally speaking, it's a lower rate. The rate that you get on a loan, whether it's a personal loan, whether it's a hard money loan, or it's a loan from Aaron Chapman and Security National, or it's a loan from an insurance company against the policy. The rate you get is based on two things: what the risk, what you are as a borrower, your risk on paying it back, and then how strong is the collateral that the lender has that they're holding on to, right? Like you give me the car you drive, which is a 70s Yugo, and I'm not feeling too good about about that collateral, right? If you borrow money against gold, even gold's pretty solid stuff, but it has gone up and down in value over time. And so they'll lend you maybe 70% of it. And then it's a decent rate, but they're not going to give you access to all of it, right? So life insurance policy loans, the collateral is sitting, think about this, Penn Mutual or Mass Mutual, they have the collateral sitting at their facility in their account. And there's no scenario where they get hung out to dry. If I cash it in, they pay off the loan before they give me the proceeds. If I die, they pay off the loans before they give my wife the proceeds, right, of the death benefit. If I decide that, I want to pay them back, they get the proceeds, right? So they're not tied to the risk of me or of the property. And as a result, historically, that loan rate is really, really of the lowest in the, out there in the world, or in the opportunity in the marketplace. And they'll lend you 100% of whatever you can pledge as collateral, and they don't even ask you when you're going to pay it back. And so all those things point to it is absolutely a safe asset. And this, practice has been going on for 150 years with no history at all, no record at all of them failing to pay you out or them losing their collateral, et cetera. Great question, Alicia.
So I've got a follow up on that, Gary.
Yeah.
If more and more people are doing this infinite banking and they start buying premiums, buying policies, and getting loans, isn't it theoretically possible to empty out the insurance company?
Not really. So here's what the insurance companies have done over the years that they've been in existence. They have saved more and more and more reserves, so that, so an insurance company is a little bit different than a bank in that a bank can do fractional reserve lending. They don't have to retain on hand enough to pay back their depositors, right? They don't even have to retain 1/10 of that, which we saw play out at Silicon Valley Bank, right? Very recently. So they just didn't have the money to pay them back because they put it to work in the, in investments. So insurance companies are required to reserve north of 80% of all of the policy cash values that they have. So you may ask yourself, well, like if they're doing that, how are they even putting any money to work, to put anything into an investment? So they're putting to work almost 2 times what they have in policy cash values. So this isn't making any sense. Well, they've built up a pool of money, a pool of investment money that far exceeds what they have in cash value. And so they hold enough of it back to pay out all this cash value. And then they still have twice that much to go put out into the economy and grow for the policyholders. So a run on the bank, if you will, at an insurance company, if you got up over 80%, it would be possible. But let me go back to, and I should have answered your question this way. they have on reserve enough for everybody to max borrow against their policy. And if you did max borrow and then you canceled your policy, that is not an event that causes the insurance company to have a bigger problem, right? It gets paid off there. So that's why this scenario is not there. They don't do fractional reserve banking, and they have on reserve between 80 or more percent of the cash values.
Okay.
And in truth, throughout, all the way back to 1939, when they started allowing people to borrow, so almost 100 years, the highest of that policy loans have gone has been less than 10%, far less. We're in single digits since the history of when they started this in 1939. It's just not that popular.
Okay. It looks like Aaron has another question in chat.
Wonderful. Yeah, Aaron. So for MEC life insurance policies, does taking a loan out avoid the tax penalty on distributions when under 59 and a half years of age? No. So let me explain this for those that don't know what we're talking about. So there are probably 100,000 IRS terms that don't adequately describe what they're talking about, right? It's all technical language. But there is a terminology that came out in 1986. Congress wanted to limit people, wealthy families, from using life insurance exactly like this as a tax-free banking system for generations to come. The idea from John D. Rockefeller and others was put these insurance policies in a trust and then dump all of your wealth into the trust, into these policies, access that, live on the profits from it, but never ever take them out of the trust, right? And so they wanted to limit how much could actually go into these things. And they didn't limit it on a dollar amount, but it's like a percentage of the policy. So you can overfund with this green stuff, but there's a limit. You got to have a decent percentage of it be in the blue down here. If you exceed this thing, then it's called a MEC policy. It's a modified endowment contract kind of policy. It acts very similar to a 401k or an IRA at that point. When you take money out of it before age 59 and a half, you get both a 10% penalty and you have to pay the taxes on the profit portion of it. If you're familiar with annuities, so if you access the profits from an annuity that you have, that your brokerage guy got for you, then anytime you touch the money, you have to pay taxes on it, right? So that is happening when you access the MEC policy. So there is a age 59 and a half element to this, but that's about that 10% penalty thing. Anytime, even after 59 and a half, when you access either taking a loan or actually withdrawing the money, you will pay a tax on the portion of it that represents the part that's profit. So the answer is, you see, does taking out a loan avoid? No, it does not avoid. Loans and withdrawals from MEC policies are they are taxed. And if you're under 59 and a half, there's an additional penalty on it. That might have put some people to sleep.
So I've got another question for you. My last question now, because I know we're running against time. What's the worst case scenario? What's the biggest risk somebody could have in moving forward with an infinite banking policy?
Great question. Great question. So realistically, okay, so I'm going to say the biggest realistic risk, right? So the insurance companies could go bust. America could be destroyed. Right? So all those things could happen. But throughout 200-year history here, the biggest risk about people losing money in these is that something causes them to quit before they're at least 5 years into it. And the result of that is that, you can always cash things in, take your soccer ball and leave and go home, which means you cash it in for whatever available cash value there is. And in the first 5 years, there's something slightly less than 100% of what you've contributed. So you could, be 4 years into it, cash everything in because you lost your job or whatever the scenario is. You met somebody who convinced you it was a scam and you cash everything in, and you're at like 95% of what you've contributed. So I guess I would say that the worst scenario is that you have to quit early and you end up not having all of your contribution back. But that decrement to what you started with is somewhere between 0 and 20% of what you've put in, right? And that's just one bad day in the markets, right? So that to me is the worst case scenario. We could say, well, what if the insurance company fails? I mean, they haven't even had a bad year. So it is possible. It's just, I mean, these companies were paying out checks during the American Revolution, right? And so people say, well, what happens, another question, what happens if the currency defaults? Well, none of us know who are living what happens when the currency defaults, but Penn Mutual Corporation, Mass Mutual Corporation, were dealing with that exact scenario when they thought for years that the South was going to win the American Revolution, right? Because the currency wouldn't exist if that would have happened. So they had to figure these things out. They were around during the Great Depression for 8 years where all the banks were failing and they were profitable. So I'm not going to say there's no risk. That would be negligent on my behalf. So there are scenarios where you can lose money. Yet the protections and features and the track record of these companies, I lose sleep about a lot of things sometimes. It is not about me losing my money in life insurance. So hopefully that wasn't overly rosy picture, but that's not where I'm worried. Great question, though, Kish.
No problem. We have a couple minutes left, guys. So if anybody wants to just go ahead and unmute, please go ahead and do so.
Cool.
And for the guys,
A quick question. So let's say in your scenario where you have to pay the down payment for 20,000, right? Let's say I have both the cash and also the cash value from whole life insurance after I find it for 5 years. Which one should I use in that scenario? The cash in my checking or the cash value for my policy?
Yeah. So this is a great question, Rio. So I get this question all the time by clients from numerous different versions. What is the best, like, I'm going to do this. I'm going to buy a car. I'm going to start a business. I'm going to buy a rental property. What is the best place to get the capital to go do that? And so there's kind of, at that moment, there's this hierarchy, and this gets more into wealth strategy. So the first question I would ask is, if you have money sitting in cash, will it fit in your policy, right? And if it will, I'd put it into the policy and then borrow against the policy. And then remind you, don't let it sit in the savings account like that, like sweep it over when there's room to do so. But let's assume for this scenario, in Rio's scenario, there is no room. Like you've got the money already set up for your next payment to your policy. And then you've got this extra cash that won't fit. Then I would use the cash. And the reason is because if there's no better place to store my cash or to grow that cash at the moment, it's basically worthless to me. And so I might as well get rid of it instead of taking on a loan against the policy. But that's really the only scenario where I would say I would use the cash. Normally, I'm saying, well, shame on me for having my cash sitting in my checking account. I need to get it over here and get it growing, right? And then once it's sitting there, I'm going to access it from there and repay. So hopefully that answers Rio's question. Nice advanced level strategy kind of question.
excellent. Thank you. So it looks like it's on top of the hour. So Gary, if people want to reach you, what's the best way to do so?
Awesome. Thanks for the reminder. So I will, let's see, hopefully put it on the screen here. There we go. All right. So my email address, Gary Pinkerton. You can learn more about me just at that same website. Oop, what's that again? There's a lot of videos I can send your way, teaching this topic at greater detail. And then please go out and watch a couple or listen to a couple episodes of my podcast. I talk about a topic called agency, and I would love to hear your feedback on helping America grow stronger and keeping our freedoms around and helping you all achieve your dreams. I really appreciate your time.
I will post all this stuff in our internal page. I will also share the recording with those. And if anybody wants to reach out to Gary or Aaron's contact information is already in our system, but feel free to reach out to Aaron for any financing questions or even policy type questions. But Gary is the strategist here. Definitely reach out to him. He's got the knowledge. He's shown that he's got really good examples. He can absolutely help you. So Gary, thank you so much for coming on, speaking with us. We all appreciate it.
Thanks for all you do, my friend, getting the word out there on, some prudent investing. I really appreciate it. It was my honor.
Aaron, good to see you as well.
Everything you said right there, we use it, we do it, a lot of it. I can help you guys make sense of it on the finance side too, and how to use it as on the when you're getting financing. Most banks don't know how to, so definitely open up for questions on both me and Gary.
Absolutely. Good point.
Okay.
Thanks, everybody.
Thank you, VMware. Thank you, Aaron. Thank you, Gary.
Guys.
Take care, guys.
Take care.
Thank you.